Good morning from our global headquarters in New York. I'm Alix Stewart. You're welcome to Bloomberg Brief. Let's set your agenda. Losing velocity, the global stock rally continues following the biggest single-day jump since 2022. Chinese inflation picks up. CPI unexpectedly rises in July, but weak domestic demand remains a concern. And Vice President Harris and Tim Walz continue their swing state tour. We speak to Lindy Li, member of the Harris National Finance Committee. Good morning to you. You've just had one of the big turnarounds since November 2022 in the equity markets. We are up this morning, but there's a fundamental question you need to ask yourself as you wait for the CPI and the retail figures next week as to whether the carry trade is really completely unwound. And this is the perilous question you need to ask yourself when we're trading dollar-yen at 147. I like what Carly Garner said to me yesterday. We had an uncivilized rally. And this is a level of uncivilized complacency. As far as equities are concerned, UBS say, look, solid growth with rate cuts can give you 17% upside. By the way, Bank of America say sell the first rate cut. I mean, take your choice in terms of who you actually follow. But wow, what a turnaround in these bonds. I mean, in the space of 6 days, this time last week, we were pretty much at this level. We dropped to 366. We've turned it around. And the auction yesterday was, as Nat Alliance say, another lousy auction. The 30-year auction tailed. So there's a little bit of indigestion in these bond markets. It's going to be a bumpy road, according to Dan Iverson, and a harder landing probability rising to 25 from 25 to 30%. But you need to ask yourself what happens with yen. Is BNY right? That you're too bearish? Still too bearish on the yen. We can get to 100. It's their fair value. And that, you know, the carry trade. JP Morgan say 3/4 of the carry trade is done. Citi say we're out of the danger zone with the carry trade. Speaking to people on the IB this morning, they are also saying in the cash FX market, and this is important, in the cash FX market, probably 3/4 of that is done. That's in conversation with various guests on the IB. Well, we also have had another piece of data this morning to China. The consumer prices rose more than expected in July, but concern about domestic demand remains writ large. Let's talk through these numbers. Tom McKenzie is with us. Tom, you spend a lot of time in China, so digging through this data should be a walk in the park for you. Top line versus the core. It's important that we draw this distinction and what the drivers were.
Yeah, that distinction is really important, Manus, because top line, the numbers came in for consumer prices, an increase of 0.5%, 0.5% in the month of July, as you said, above the estimates. But you lift up the hood and you realise that there are weather effects that pushed up the prices of things like vegetables. There was a very low base when it comes to that key input into the consumer price basket of China, which is pork prices. Very low base last year. So you can strip that out as well. And what you see at a core level is that actually prices are very soft. Prices actually came down for the likes of autos, for the likes of cars, smartphones and appliances as well. There's a massive price war going on in China and consumers are sitting out to see if prices continue to fall. The consumer and that demand picture remains very soft in China. On producer prices, you're almost at a 2-year stretch where producer prices are in deflationary territory in China, and that talks to a key concern. Exports are not kicking in. We saw that in the data out of July. Exports were soft, so they need the consumer to come to the fore if they're going to hit that 5% growth target. And that's why you have a number of economists saying there will need to be more measures from policymakers in Beijing, including a rate cut. They've outlined, senior leaders there, a 20-step plan to boost the consumer, but it was lacking in detail. That was the take from many, and it didn't come with additional fiscal support. Economists are saying more will need to be done to get that consumer back and to get those consumer prices up.
It's interesting, and we've got this angst over the policy response mechanism. You've got the yen unwinding. That could have a reverberation back on the yuan. You've got the Aussies talking about a pretty hawkish narrative in terms of what they're prepared to do with rates. Tom, this angst, we've seen some policy response mechanism from the PBOC this year. Some would say it's been incremental, too small, piecemeal, and not enough for the consumer. So where is the debate on the policy response in China?
It's really shifted from the need to stimulate at a central bank and monetary policy level, and as you say, they have done that, to the need to get cash into the pockets of consumers. And you've had, really interestingly, prominent economists, prominent voices in China putting their heads out above the parapet and saying it's time to get cash into the pockets of consumers. So far, though, senior leadership appears to be reluctant to do that. We do expect, the team at Bloomberg Economics expects another rate cut from the BBOC and maybe a move lower in terms of reserve ratios for the banks. We'll wait to see if they do anything more material on the consumer side.
Tom, thank you so much. Tom McKenzie there on the very latest data from China. Well, it's been a hugely volatile week for the bond markets and cross assets as the carry trade unwinds. Joining me now is Alix Stewart, Global Unconstrained Fixed Income Fund Manager over at Schroders. Good to have you with us. The debate is this, is to what extent this carry trade has been unwound. Alix, when we look at the responses, and some would say hysteria in the bond market, 366 on the downside is where we went on the 10-year government bond yields. We're back at 390. We're back almost at that 4% level. Give me your take in the level of volatility. Have we seen the worst? Is the worst passed from the carry trade? Do we move the narrative on now?
I'm not sure that that's exactly the case. I think things have got a little bit ahead of themselves in terms of fears of recession and I don't think that actually what has happened recently has changed an awful lot. Obviously, with the Bank of Japan raising rates, that has caused a bit of an unwind, but I don't think that we are actually heading for a recession and that the worst fears will be realised.
I mean, when you look at the flow in the bond market, as I say, we crashed to 366, talk of an inter-Fed cut, 50 basis point cut. Let's just listen to the Richmond Fed President, Tom Barkin. He spoke yesterday about the central bank's path forward.
I think you've got some time in a healthy economy to figure out whether this is an economy that's gently moving into a normalizing state that will allow you to, in a steady, deliberate way, normalize rates, and stick the landing, if I could use another balance beam analogy. Or, is this one where you really do have to lean into it?
So that is the debate, how much time they have and what they do. If I look back at Bill Dudley just 10 days ago saying, look, he's pivoted from being from a hawk to a dove. Listening to Barkin, we have time, but will the market afford them time? Do they need to do a precautionary 25 basis point cut in September to avoid a harder landing?
I mean, that is the question. To be honest, I don't think that the data is bad enough and that they really need to panic at this juncture. I mean, I think, I think we've got very used to the fact that the Fed put was there previously for, stock market wobbles. But I think that, they'll be going to be quite cautious about signalling that. And they'll be, doing as they've been saying and keeping an eye on the data. And it's probably quite, balanced as to whether they need to go just now. I think they will be a little bit cautious about trying to signal that they're panicking in any way.
And if you look at bonds, it's interesting. The conversations I've had this week has been, the 60-40 portfolio behaved pretty well. Bond markets pretty much took the lean as a hedge. And I just wonder at what level you say to yourself, look, there's been quite a significant rebound in 10-year government bond yields. I know Dan Everson over at PIMCO says it's going to be a bumpy road, but he would be prepared to add in 10s at 4%. They just look a little less attractive than they were. From a duration point of view, how does duration look to you?
I mean, I think we got a little bit overdone. If you look at where we got to on Monday, it was very much, emergency rate cuts were being priced in. It was very hard to see at that juncture, how much more they could be expected to do. I think there was a little bit of a panic. We are in summer markets. The volatility can push things a little bit too far. I mean, we've retraced a little bit from there. And possibly could do a little bit more. I mean, I think longer term, obviously, we are about to be starting a rate cutting cycle. So, duration is not unattractive, but I just think we got to a point where there was just too much priced in.
Yeah, I mean, there was a certain hysteria to this market. Now, in the past 24 hours, politics is never far from the agenda on Bloomberg Brief, and the former President Trump spoke at a press conference yesterday, and whether a president should have a say in, you got it, monetary policy.
I feel the president should have at least say in there. Yeah, I feel that strongly. I think that in my case, I made a lot of money. I was very successful, and I think I have a better instinct than, in many cases, people that would be on the Federal Reserve or the chairman.
Now, to your average bond investor or bond manager, that possibly strikes fear. If there was ever an example of a toxic combination between politics and monetary policy, it was this week in Japan. Hiking rates, some would say, you know, the Bank of Japan learned a salutary lesson from the politicians. When you hear that from Donald Trump, how do you think bond investors would react to that concept?
Yeah, I mean, it's a little bit concerning. I think, you know, there has been a little bit of maybe, you know, we saw it in the UK not that long ago, that, you know, that politicians quite often just assume the bond markets will be there to fund whatever. And actually, you know, we have to see that inflation is going to be under control and that we are on a steady course. So, yeah, I think there would be some concerns about that.
Yep, it certainly would bring into question that unique position that US Treasuries have in the world. Alix, thank you very much. Alix Stewart there over at Schroders. There are other stories trending on your Bloomberg terminal this Friday morning. If you're still with us, the UK is weighing steps to tighten rules for online platforms such as X. This comes after days of rioting in the UK. Prime Minister Keir Starmer called for a mature conversation with social media companies to limit malicious content. Donald Trump looked to recapture attention and momentum in his race against the VP. Kamala Harris dangling a series of debates and fielding reporter questions for over an hour at the Mar-a-Lago resort on Thursday. Their first debate is expected to take place on September the 10th on ABC. An earthquake near the coast of one of Japan's southern islands has prompted the government to issue its first ever warning of a megaquake. The country's prime minister called off a planned trip out of caution. Bullet trains ran at reduced speed and some chip-related factories temporarily halted their production. Coming up, Taiwan Semiconductors sees a 45% revenue spike in July. We'll take a look at what that says about the AI demand structure right here on Bloomberg. Good morning. Let's take a little bit deeper into these markets and equity markets specifically. It's been a wild week. Joining me now is Gina Martin-Adams, Bloomberg Intelligence Chief Equity Strategist. I mean, Gina, if you just look at the VIX through the week, I mean, parabolic moves on the upside, a little bit of temperance. The S&P never quite made it into correction, but the NASDAQ took a much more aggressive dip. When you stand back 6 days later from the jobs report, how do you contextualize what we've just seen?
Yeah, it's been a wild ride for sure. But when we really think about what's happened in stocks, you can date it all the way back to the turning point at the middle of July, which was really sparked by a change in the yen, which led to the change in Bank of Japan policy, which is a generational shift. We're contending with the first hike in interest rates in Japan in 17 years. That sparked a bit of volatility that was then exacerbated by the bond market's anticipation of U.S. economic data or interpretation of U.S. economic data as imminently likely to create a major Fed easing cycle. That divergence in policy rates has created this carry trade unwind. And remember, that carry trade had been building up over nearly 2 decades in time. So we did have this vicious response in equities over the weekend. I do think that the Bank of Japan's statements that they're unlikely to continue hiking as long as volatility in financial markets is in play really created the stability. But that, along with some rationalization in the bond market regarding an interpretation of the economic data, through the course of this week, the economic data has come in pretty stable. So I do think we have that sort of right sizing of expectations going on, and that's definitely fed through to equities. You know, the most liquid stocks in the world, of course, being the biggest of the big cap stocks in the U.S. markets really have taken it on the chin, along with the Japanese equity market. So I think that that's a lot of what's going on and what's at play here in the coming weeks. We've got to watch the Fed and the Bank of Japan probably as our most key indicators.
I mean, I like what Mark Cudmore said on the M Live chat. It's the market, not the economy, that is structurally problematic. And that's true. But that plays back to your point, which is in these vortexes of where we deleverage and see risk off, you go to the most liquid assets, first of all, to divest those. Obviously, ground zero is Mag 7, large tech, big tech. But you look at the valuations after all of this angst, and you look at the sector overall, I know that, and on a PE basis, it's trading just below we were at the highs of the pandemic. But can you split that out for me for the group versus, let's say, Mag 7? Has there been a significant revaluation in the PE for Mag 7?
Yeah, unfortunately, no. This is still a group that's incredibly excessively overvalued. Now, stock by stock, I think it's important to look at the Mag 7 stock by stock too. But when you look at the group as a whole, we're looking at still near record level valuation spreads in particular compared to the S&P 500. And that I think is really important. It's the spread that is probably most indicative of the excess optimism in this space. It's also what's created the sort of impossible expectations that these stocks have faced throughout this earnings season. But that spread does suggest that while we've piled all of our hopes and dreams into the Mag 7, the rest of the S&P 500 has very, very low expectations implied in valuations, at least by comparison. And that does open an opportunity for investment as we start to see some clawback of earnings progress in the rest of the index, the 493 stocks that are not Mag 7 stocks. We should start to see capital flows improve for those companies. We should start to see some stabilization and maybe some right-sizing of valuations in that group as well to catch up. Now, I think at the same time, you've got to consider how the Mag 7 can grow into their multiples. Historically, what's happened when multiple spreads have gotten so high is Mag 7 prices simply stop rising as fast as earnings. And we could see earnings produce a bit of catch-up, allowing for those multiples to normalize. I think your natural proclivity is to worry that prices have to decline in order for multiples to normalize. I just want to put out there that multiples can normalize in more ways than one. You can see earnings catch up to price, and that may be a period of time that we're moving into now.
Gina, let's see whether we get a little bit more volatility. We've got CPI, we've got retail sales next week. So again, we're living day by day on this data in terms of the emotional response by these markets. Gina, thank you very much. Gina Martin-Adams of Bloomberg Intelligence, wrapping up a week of huge volatility in equity markets across assets. Coming up on the show, we'll take a look at the other headlines around the world on the papers and the sources that we check, including President Biden's efforts to break the deadlock on the ceasefire talks in Gaza. Context matters on Bloomberg. It's your Friday edition of Bloomberg Brief. I'm McNally in New York. Front pages, this is what we've got for you. Headlines from around the world. First up, the Journal leads with Biden's move to break the Gaza talks deadlock. The US, Egypt, Qatar are making a last-ditch proposal to reach a ceasefire agreement with Gaza. Leaders from both Israel and Hamas are urged to meet on August the 15th for negotiations. Of course, a lot of this is going to come down to the response that we see from Iran onto Israel. Still waiting. The world is still waiting for that response. What impact will that have on those discussions? Next up, New York Times, Ukraine's push into Russia. It's surprising turn in the war. The Ukrainian forces advancing several miles across the Russian border into the Kursk region. Now, the attack caught Moscow off guard and opened up a new front in the 30-month war. TSMC's revenue rose by 45% in July, accelerating its pace of growth. This provides optimism that the AI chip demand remains strong. Let's dig into those numbers. Peter Elstrom is with us to go through these numbers. So, Peter, look, 1 month, a nice set of numbers for TSMC. What's the first read on that, on the broader picture?
Well, it's a very good point. This is just 1 month of sales that we got from TSMC. Taiwanese companies report these monthly sales, which can be indicative of what's going on more broadly. I think after the big scare that we got in the market earlier this week with the Monday troubles in the stock market. Everybody wants to see the next sign of where exactly this is all going. And TSMC is a very good indication of what's happening in the semiconductor industry. So this is an indication, the 45% bounce that they got in sales in July is an indication that maybe they're going to surpass the expectations for the third quarter. Those are about 37% right now. TSMC makes the chips for NVIDIA, for AMD, and also for Apple. So it begins to give you a sense that demand from those customers is pretty strong for TSMC right now. Now, is that enough to kind of prove that the AI trade is back on, that things are positive? It's only one data point at this point, but it is a positive data point. And I think that's giving some investors some reassurances that people are still buying these chips.
Look, they have a dominant position, there's no doubt about it, in this marketplace in terms of their ability to price and in terms of the flow of business. Do you think that out of what, I don't necessarily know that out of 1 month's data you can extrapolate overall AI demand. The issue is more about monetization of AI capex. But from the demand side, what do you think this can tell us?
Yeah, that's a very, very good point. These are the suppliers of the equipment to the big companies that are making these massive investments in AI services. So the customers for NVIDIA and for TSMC, by extension, are the Microsofts, Metas, Amazon, and Alphabet. They're the one making these multi-billion-dollar investments in AI services. And what we don't know yet is whether those services are going to pay off.
Gotcha.
We know that they're buying a lot of chips. They're buying a lot of chips from NVIDIA and TSMC. But where's the revenue on the other side?
Okay, Peter, thank you very much. Wrapping up the TSMC numbers. One swallow does not make a summer. Peter Elstrom there with the very latest. We'll take you through what's going on with the oil markets, and also we're going to catch up with Lindy Li. From our global headquarters in New York, it is Bloomberg Brief. I'm McNally. Time to set your agenda. Losing velocity, the global stock rally stalls as markets question a renewed push of the carry trade unwind. Chinese inflation picks up. CPI unexpectedly rises in July, but weak domestic demand remains a concern. And Vice President Harris and Tim Walz continue their swing state tour. We speak to Lindy Li, member of the Harris National Finance Committee. A very good morning to you. To what extent are these equity markets reflecting on the scale of the unwind and the carry trade? Either way, we managed to put on one of the best days performance since November 2022 on the back of one small piece of data. No serious injury from the jobless claims. Is that enough? We look forward to CPI and retail sales next week. We're up by 0.3%. TSMC's helping the tech and the chip side of the business. But UBS make the point, look, if you've got reasonably solid growth, i.e. a Goldilocks kind of scenario, and rate cuts, they actually see 17% upside in these equity markets. If anything, this vicious and pernicious volatility that you have had this week is indeed for them a contrarian signal. Then the other side of the trade is Bank of America say sell the first rate cut. You know, you can take your choice. The market has certainly repriced the capacity of rate cuts. We've whipped it around from 366 on the downside to call it 4% for cash on bonds at 395 at the moment. Yields dropped by 2 basis points this morning. Again, the narrative is this. You no longer need an inter-Fed cut, nor do you need 50 basis points, but do you need an insurance cut of 25 basis points? Also on the bond auction yesterday, it was another tough sell. Nat Alliance called it another lousy auction, and Dan Iverson says you're going to have a bumpy ride in these bond markets, but he would add duration at around the 4% level. It's just not as attractive as it was. You just need to debate whether the carry trade is really undone. Citi say the worst of it's done. JP Morgan say the worst of it is done, and I've just had an IB from Kit Duke saying he feels that 3/4 of this, if not more, of the unwind has been done. But, you know, fool me once and all that jazz. So that's the state of play on markets. NVIDIA is up 2.25%. Still, it's had a pretty tortured tour from the very top to the bottom. The Nasdaq obviously making it through and into a reasonable level of correction. The S&P 500 never quite made it through the correction. Okay, we are less than 100 days away from the U.S. election. Donald Trump has agreed to debate the Vice President, Kamala Harris. Meantime, Harris and her running mate, Tim Walz, continue their swing state blitz. Here's what they said on their tour.
We got some work to do. We need to move to the general election and win that. And to all the friends, listen, we also need to level set. We are the underdogs in this race.
We want to recognize the right all people have to freedom and liberty to make choices, especially those that are about heart and home, and not have their government telling them what to do.
Donald Trump's not fighting for you or your family. He never sat at that kitchen table like the one I grew up at, wondering how we were going to pay the bills. He sat at his country club in Mar-a-Lago, wondering how he can cut taxes for his rich friends.
I know exactly what we are up against.
Joining me now is Lindy Li, member of the Harris National Finance Committee. Great to have you with us. Timely to have you here.
So nice to be here. Thank you so much.
Good to see you. I mean, some people are saying this is almost like Clinton Gore, this team up, the response in the halls, the kind of momentum that they have delivered. How strongly are they cutting through as a team, as a combo?
Oh my goodness, they've been a powerhouse together. The blue wall is back in play. Michigan, Wisconsin, and Pennsylvania, my own state. Harris is leading in all three. It's just been absolutely phenomenal. She raised $310 million in the month of July, and it wasn't even the month of July. It was the final 2 weeks of July. So this is just mind-boggling, and we are absolutely thrilled. I was lucky enough to be at the first rally in Philadelphia. She invited me to the VIP reception. It was just, and watching them both, Walz and Harris, they have incredible energy together, and he is very down to earth and makes people feel comfortable. He's exactly the kind of person we need on the ticket.
Well, they're certainly selling, you know, the folksy teacher, military side of him. Now, you say Pennsylvania is leaning towards Harris, but we've done our own polling here that shows Trump is up 4. Yes, she has cut into his lead, but it's not leaning to Harris. So what are you seeing? Where are you seeing that? What exactly are you seeing when you say it's leaning to Harris?
I'm seeing the young people who are finally galvanized, the young people who are sitting on the sidelines, the 30% who weren't happy about Biden being at the head of the ticket. Now it's overwhelmingly, Democrats are overwhelmingly thrilled to have Harris at the top of the ticket. I haven't seen this energy since 2008 when I was a kid supporting Senator Obama. She's completely upended the landscape. Georgia is back in play, for goodness sake. So she's completely upended the math. She has many paths towards 270, and this is the right thing for the party.
But can she get that path to 270 without Pennsylvania? Because Shapiro's off the ticket. So I suppose the question is, without him on the ticket, can she win Pennsylvania?
I think people need to remember that he doesn't need to be on the ticket to be an effective surrogate. He's going to be out there. He's committed. On Tuesday, he even said himself, he's going to be out there every single day making the case, prosecuting the case, litigating the case against his convicted felon who faced 88 criminal charges, 4 indictments, 2 impeachments. You all know that 26.
Yeah, we've got the laundry list of felonies, etc. I suppose what we want to know from our perspective is, what's her policy that's going to work in Pennsylvania? It's a huge energy state. She was against fracking. She sort of railed against that. Now, when's she going to come out and make a very clear statement on energy and fracking? Because she hasn't done any interviews yet.
Well, she kind of did one on the tarmac today. I know she's going to do a more extensive one later in the month. She already spoke with her staff, and she committed to doing one. And they're also going to debate on September 10th. One thing I do want to mention is she did say she's no longer in favor of the fracking ban. So she's making concessions, and she's also going to make sure that people know she's the rule of law candidate. Do you want stability in the markets? Do you want to prevent a free fall in the stock market? Do you want rule of law? Do you want to revere the Constitution? Then Kamala Harris is your candidate, not the convicted felon. How do businesses prosper when there's a tumultuous environment?
Well, I think I understand all those statements, and both sides make the same kind of thing. You know, do you want a strong stock market? Do you want a stock market that crashes? I think what people want is fiscal responsibility in the first instance, rather than hyperbole about whether you want a higher stock market. I mean, the jobs market is strong at the moment. Unemployment has risen ever so slightly. Growth is solid in the United States of America. There's no talk about a parabolic drop in the equity market if Trump came to power. Let's talk about the money. The campaign's doing well. You've said that, the scale of the money that has been raised. I'm just wondering, is Walz, is he carrying through? Is he hitting through in terms of raising his own money? Any numbers there that you can give us?
So I'm one of Harris's biggest donors. I sit on her National Finance Committee. I raised $1.1 for Biden over a course of a year. I raised $2 million over a course of 5 days a week, essentially. So the comparison is just mind-boggling. And with Biden, I had to do a lot of sweet talk, a lot of like finagling kind of thing. But with Harris, people are just like forking it over. They're so eager to get on board.
Who's the biggest donor so far? Who's the biggest ticket that you've raised for since
well, I don't want to.
Oh, break news. Feel free.
Well, I don't want to divulge confidences, but you will find out eventually on the FEC report. But this is someone who's able to write 920. What was that?
So it's one ticket. It's one check for how much?
One check for the maximum $929,600. I think is the limit, because they have a joint fundraising agreement with all the states. That's what that allows them to donate more than the $3,300 stipulated by the FEC.
So the one thing that we saw with Harris on the money side, which was invigorating people who've never donated before, perhaps who haven't been politically active before. 66% of the money that she raised was from new donors. What can you tell us about the flow of money, these new numbers that you're talking about in terms of new donors?
I'm seeing it myself. I'm actually leading a fundraiser called Christians for Harris. I'm a Christian, and that's on Monday. We have small dollar donations just pouring in, and these are like $50, $20 even. $100. These are not big ticket donations, but an accumulation of many of these small contributions, it's an avalanche. It's just phenomenal. I've never seen anything like this before.
Which social media platform is doing the best for you in terms of raising the money?
Twitter. Twitter's one, and then TikTok, because she's winning the meme game. I don't know if you've been noticing.
Yeah, no, we've got that.
Exactly.
Yeah, Kamala is bad. What sort of ads are you going to buy with the money?
3 words. Pennsylvania, Pennsylvania, Pennsylvania. As you mentioned just a few moments ago, Pennsylvania is the ball game. If we win Pennsylvania, she has the White House. So both campaigns, actually, both Trump and Harris have committed to spend hundreds of millions of dollars in the state. I'm actually a commissioner in this Commonwealth, so I have my finger on the pulse of the situation. And I have never seen young people, and women in particular, so excited about this ticket. Because Trump is the candidate who overturned, he's the one who appointed the 3 justices who overturned Roe v. Wade, and that's something that we will never let him forget.
So by the very nature of what you just said is Pennsylvania, 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 Pennsylvania is, if you don't win Pennsylvania, there's no road to the White House.
There's no road. It's going to be very difficult. We need Pennsylvania. We need Pennsylvania. We need Georgia. If she has both, we win. Okay.
We wish you well on the campaign trail and with raising more funds. Well done on the efforts so far. That is my guest this morning, which is Lindy Li of the Harris National Finance Committee. Coming up in the show, we'll dig into the crude markets and check in on the developments on what Bob McNally thinks about the Middle East. Bloomberg Brief, I'm McNally in New York. So oil is poised for a weekly gain after a string of losses as traders continue to watch developments in the Middle East. Rapidan Energy Founder Bob McNally says this of the market: oil fundamentals are broadly neutral. Crude prices are struggling against a macroeconomic pessimism, punctuated by sporadic and brief geopolitical mini spikes. While we expect Iran will pull its punches to avoid a regional war, the market remains too complacent. Bob joins me now. Bob, you have joined me on several occasions when we have been in anxious periods of waiting to see what the Iran response mechanism is to Israel, and obviously their moves on Hamas and Hezbollah. We don't know what that response mechanism is at the moment. The calibration, your assessment of what calibrated response might be.
Good morning, Manus. So our base case is that Iran must thread the needle and will respond to the recent eliminations in Tehran and Beirut by Israel with a retaliation that is sort of strong enough to sort of try to dissuade Israel from continuing those attacks, but not so strong that it triggers a regional war. And they'll do it unlike April, which was just an Iranian attack on Israel. This time it's probably going to involve, even feature its allies, Hezbollah in Lebanon and Syria and Iraq, and maybe the Houthis as well. So more of a broader front. But it's a Goldilocks type of revenge they're looking for. Not too hot, not too cold. And then, Manus, there is the chance that there will be a breakthrough on the peace front. In other words, Biden administration right now is scrambling to say, look, call off the retaliation. Let's get a deal in Gaza. So those efforts are underway. But we think base case is Iran and its allies will retaliate here.
Would a multi-pronged retaliation, as you say, via the proxies not be something more significant than the three, in April time, it was 300 projectiles, 170 drones, 120 ballistic missiles. What you're framing to me sounds more substantive than that, or just clarify.
It depends. So Hezbollah in Lebanon, with its inventory of missiles, actually poses a bigger threat to Israelis than Iran. So it depends on what Hezbollah does. Manis, I think the most important metric to watch, God forbid, is whether there are Israeli fatalities. In April, no one died.
Yeah.
Look what happened when the Houthis killed one Israeli in Tel Aviv with a drone. The Israelis lit up the port of Hodeidah and killed several people. So Israel is in sort of a 3 eyes for 1 eye, not eye for eye, 3 for 1. So it all depends on whether Hezbollah and Iran cause fatalities in Israel. That'll determine whether we leg up in terms of geopolitical risk and crude, I believe.
Which then takes us to the response mechanism. We're just showing the price of crude at the moment up 3.74% on the week. But I look back on the chart here. Obviously, it's been really brutally taken down by the macroeconomic de-risking concerns. Here we are. We're back to reassessing war and geopolitical risk. When you look at the demand side of the equation and the war side of the equation, are we at sort of a cap here in terms of the market, because the demand side will ultimately pull us back?
You know, I think both on the demand and the supply side and the fundamentals, oil is sort of trading sideways. I mean, across different products and across regions, you can find pockets of strength. U.S. gasoline, even total oil demand in May, blockbuster strong. India, soaring. China, weak. Jet fuel is white hot globally. Gasoline, firm. Distillate, the economic fuel, weak everywhere, especially in Asia. And if you look at differentials and spreads and physical trades in Europe, Brent is starting to show some life. So as we look across the complex and we analyze the data, you can be a bull, you can be a bear. It's sort of neutral here. It's signs of stock draws.
Okay.
But the market, as you said, is not trading off of this. The market is trading off of macro, Bank of Japan, Federal Reserve, and geopolitical risk occasionally.
Let's take the optimistic side that Iran threads the needle, no massive escalation or injury. I mean, these are all very, very, very optimistic scenario plans. But let's say the response mechanism, and that there is a geopolitical de-risk, a coalescing of the minds on August the 15th. My question to you would be then, progress on a ceasefire, put that to one side. With, as you say, macro worries and China's lethargic demand, can OPEC Plus actually continue to add the barrels back on the program that they've outlined?
Not without accepting lower prices. I think as we sit here today, OPEC Plus leadership still intends to launch the tapering. It's scheduled in October. But that's, 180,000 barrels a day per month. It's not too much. We don't expect much in terms of these compensation cuts. If you believed Iraq is going to comply with its compensation cuts, OPEC Plus supply is going down later this year, not up. But it's unlikely Iraq will comply. More likely, they will launch it, Manis, but it's going to be a week-to-week, month-to-month sort of monitoring of the conditions. I believe Saudi Arabia, UAE, Russia, they are able and willing to pause that tapering if they see fundamentals weakening. But right now, they're sort of looking through this macro noise and this short-term volatility in crude prices, and they believe fundamentals are starting to move their way.
Tell me this, Bob, you've advised at the White House in various administrations gone by. Here we are. Politics is never far from the oil market or from the White House. Kamala Harris has done a volte-face from wanting to ban fracking. Obviously, it's very important in Pennsylvania, to something different. We need clarity on exactly what that is. How do you see U.S. oil policy under a Harris presidency?
Under a Harris presidency, really, no president can really do much to unleash production in terms of increasing crude production. The industry operates at all out. We don't have spare capacity. However, a president has the power, Manus, to hurt oil production and gasoline and refinery output. So with Kamala Harris, she says she no longer supports banning fracking. Were she to try to do that, she'd need Congress, unlikely to happen. However, and we've talked about this in the past, the president has a pen and the authority to restrict or ban exports of crude. So if a president wanted to hurt U.S. production, they don't have to ban fracking. They can just restrict or ban exports of crude. Also, they can declare a climate emergency and use sort of defense powers to restrict production. So there is power there. I'm sure the industry hopes that she has turned a new leaf and is not supporting a sort of a gut punch to the industry. I guess we'll see if she wins, but she has enormous power, not to help, but to hurt the industry if she chooses.
And likewise, the other side of the coin is, of course, if Trump comes back in, he could indeed be injurious to Iran in terms of the largesse of their production at the moment. We didn't quite get there. Bob, thank you very much for joining us this morning, framing the geopolitical risk and the oil markets. Bob McNally there, president at Rapidan Energy. Let's revert back to tech. We've got a nice bid with Taiwan Semiconductors, up 3.33%. We saw the revenue for last month up 45%, bolstering the AI narrative. Peter Elstrom is with me, Bloomberg's executive editor for Asia Technology. It's a nice booster for July for TSMC, Peter, isn't it?
It is. Now, this is just 1 month of data that we're getting out of TSMC. Like many Taiwanese companies, they report monthly revenue figures. It gives us a little bit of a signal about what the third quarter is going to look like for TSMC. The average projections for revenue growth there are about 37%. So this is above this, suggests that maybe TSMC is going to do a little bit better than expectations. Now, why is that important? It's because they make the chips for such key players in the market, including NVIDIA and AMD, as well as Apple. So investors may look at this and see this as a positive sign for demand, that NVIDIA is beginning to sell the chips, the new AI chips that they're bringing into the market. There's strong demand for those kinds of things. After the scare that we had earlier this week in the market, that may be somewhat reassuring. But again, it's just one data point. It's just 1 month. So there's some caution around that, too.
Is there much of a read across on the broader implications of this? It's obviously something that helps the narrative. We've had quite a de-risking on big tech and in the Mag 7 and in the AI space. So what do you think the broader implications are?
I think the big question right now in the AI trade is not whether NVIDIA can sell chips or whether TSMC can make chips and then sell them into the market. The big question is whether the companies that are buying all those chips, the Microsofts, the Meta, Alphabet, Amazon, whether they're going to be able to generate revenue on the other side and show that these big multi-billion-dollar investments that they're making in AI services, AI chips, are actually going to pay off in the long run. And that's a question we just don't have an answer to at this point.
Peter, thank you so much. Peter Elstrom there with the very latest on TSMC. We'll run you through the schedule for the rest of the day in just a moment on Bloomberg. Let's lay the landscape out for you for next week. On Monday, the former President Trump is interviewed by Elon Musk. Tuesday, we get real insight to some of the inflation data here in the U.S. We've got the PPI followed by the CPI on Wednesday and retail sales. So again, really understanding the health of the consumer. We'll also get retail sales earnings from Home Depot on Tuesday and Walmart. That real pressure on the value end. To ground zero of risk, it is about dollar-yen, but also the bond markets. Such an explosion in volatility in equities and bonds over the week. Round trip, 366 on the low point. You're trading at 395 right now.